What's going on, option investors? My name's Henry, and if you're new, I'm continuing a series on options because that's my area of expertise when I was working at Goldman Sachs. And in this video, I'm going to explain to you how to perfectly execute covered calls so you can make consistent passive income. I have two different stocks that are very strong plays for covered calls. Both of these plays are long-term stocks that have upside, but I also don't mind doing covered calls and collecting a lot of premium. I'm trying to make sure that you could put your feet in the sand and just sip margaritas all day long. This video is designed to make you stupid rich if you stick with me, because covered calls are the simplest and easiest way to make your stocks work for you and generate income. You do need some money to do covered calls, but you really don't need as much money as most people think, because you can absolutely run this strategy on cheaper stocks. This is a strategy that most option millionaires use in their toolkit, and the sooner you master it, the better. With that being said, before I flood your pockets with money, if you appreciate my work in teaching you options, then just smash that like button for me. It makes me happy and it keeps me grinding to teach you guys more about options. I do have an option Discord, which is where all my energy and time goes. We beat the market by 7% in September, and the only way you can get that, and I ensure that nobody ever gets scammed because there's a lot of scammers in the comment section and on Instagram, is for you to talk to someone live on my American team for absolutely free. Application in the bio. All right, let's get into it. The first stock I want to discuss that I am bullish on, but also I see as a very good covered call opportunity, is NIO. No surprise right there, because I've been a bull on NIO for a very long time. Now, NIO released its September and third quarter 2021 EV delivery data on Friday, and its quarterly deliveries exceeded the internal guidance that it had revised lower on September 1st due to supply chain constraints. NIO is expanding abroad with a team now active in Norway and sales planned for Germany next year. I've been a long time bull on NIO, as well as the overall electric vehicle industry. NIO stock is trading for under $35 currently, which is way off its peak price of over $60 per share in January. NIO is a long-term growth story for investors. As its growth continues, aggressive investors may want to consider a dip in shares as a buying opportunity. But I'm taking it a step further by utilizing covered calls. NIO covered calls for January 21st expiration look very attractive. There's two different plays that you can do. Play number one is you can buy the shares and sell the 35 strike calls for a near the money covered call. The 35 strike has $350 worth of premium. That's a 10% return in about 3 months, or more than 40% annualized. At that rate, $10,000 would grow into $289,000 in 10 years. The second play on NIO I have is the $40 strike. In the first example, the 35 strike gives you opportunity to sell NIO shares at $35. That is about 3.5% return on top of the premium that you collect if you do lose the shares. However, if you want to leave yourself more upside and you believe that NIO stock has more room for upside, then you can also sell the 40 covered call instead of the 35, because it's going to give you more room for appreciation. By selling the 40 covered call, you collect less premium. However, you have a great chance of reward, because if NIO ends at $40 flat, or say even $39, you do not have to get rid of the stock at $35 per share like you do in the first example. The second example is going to be much better for NIO bulls that don't want to lose their shares at $35. The 40 strike only has $192 worth of premium. So rather than collecting $350, you will only collect $192. But if you do end up losing the stock, you will actually make over 18% return on the stock appreciation itself. The premium ends up being about 5.6%, so your total return would be 23.6% in 3 months, or more than 98% annualized. At that rate, $10,000 will grow into $9.2 million in 10 years. If it seems too good to be true, that's because when you do covered calls, it's not always going to rise and give you the maximum reward. In fact, the whole point of covered calls, in my experience personally through working with many high net worth and ultra high net worth individuals, is that the goal is to collect as much premium as possible consistently without actually losing your shares, because when you do lose your shares, you have a capital appreciation on your hands and you have to pay some taxes. So it's always better to continuously sell options, but ideally you don't get exercised, or ideally you can just roll your options, which I will link in the description below. I have a whole video on rolling options. So for example, if you think NIO can only go to $36 per share, then it makes more sense to just sell the highest strike possible that is nearest to that 36 strike, which would be in this example $37. However, if you believe the stock has tremendous upside up until January 21st and you believe this stock can be $45, then it makes sense to go further out up until the 45 strike. Of course, the stock can can also decline. However, a decline would still leave you in a better situation than a stock investor not doing covered calls. So not much to say there besides trade stocks that you really enjoy, because even in the worst case scenario, you're going to be better off than just someone holding the stock and not trading options. The next stock that I have for you and that I really like for covered calls or call options if you have a smaller portfolio and like buying call options yourself is Microsoft stock. There's so many ways you can play Microsoft using options. Microsoft was founded at the dawn of personal computing era. It has shown an incredible ability to adapt to new technology trends. Microsoft pretty much made a fortune and rose to prominence in the 1980s thanks to its near monopoly of the PC Windows operating system, as well as the standard Microsoft Office enterprise software suite, which we basically all still pay for. Every time I buy a computer, there's always Excel and the entire Microsoft suite. In the modern era though, Microsoft has also been able to continue this advantage. They've been able to leverage its deep ties with global enterprises to become a very formidable player in cloud computing with its Azure platform, enterprise research planning with its Dynamic 365 suite, and enterprise social networking with LinkedIn, which it acquired in 2016. I'm a big fan of Microsoft, so I'll pull out the January 21st options. And the first play I will say that looks really good is the 300 strike call option. If you sell these, you will collect $1,530. So your total return would be 5.3% in 3 months or more than 21% annualized. However, you would also make 1.4% on the capital appreciation. So if you lost the stock and got exercised, your total annualized return would be closer to 28%. At that rate, $10,000 would grow into $118,000 in 10 years. Obviously, that's much lower than some of the crazy returns with NIO, but it is much more sustainable over a long period to aim for moderately high returns with reasonable amounts of risk rather than outrageous returns with massive risk. Now, for the more aggressive investor who would like more upside and capital appreciation, the 305 covered call would be a much better option. Your total return would be 7.5% in 3 months or more than 30% annualized. The numbers on the screen might be slightly off, but at that rate, $10,000 would grow into $137 in 10 years. Again, you have slightly less premium at $998, but more total return potential. Whichever strike you decide to go with, the mechanics are the same. Your goal is that the stock behaves how it's going to while you benefit in all 3 scenarios. Scenario 1, the stock falls. Well, everyone else lost money and so did you, but you lost less money relatively to a stock investor because of the premium that you collected. Scenario 2, the stock rises, but it does not hit your strike price. In this case, your stock has appreciated just like a stockholder, but you have also scrolled away the premium that you sold on the option, leaving you in a better scenario than a stock investor again. The third scenario is when the stock rises a lot. In fact, it rises past your strike price. Now, in this case, you're still a winner. However, you're going to make less money than a stockholder who has not sold a call option on their position. However, in all 3 scenarios, it's literally impossible to be a loser because in 2 scenarios, you're better off than a stock investor, and in 1 scenario, you are worse off. However, you still made a huge return, as I mentioned in the 2 examples in this video. If you want to see my live trades, my option signals, have access to me, 2 different coaches, a licensed CPA, you can book a free call by submitting an application in the first link below for my private option Discord. Thank you so much for watching. Invest safely, and I love you guys.